Hi, this is Randy Finney with the Right Side of the Chart, and today is Monday, January 14th, 2019. In this video, I wanted to just do a brief overview on the broad markets. I've covered that plenty in detail lately, a lot of analysis there, but also hit on the trade ideas on the site right now, both official and unofficial. Unofficial trade ideas remain light. The official trade ideas, I should say, remain light. And then the unofficial trade ideas, if you factor in those, particularly those that make the front page, I throw a lot of things out in the trading room, but if something looks really compelling, it'll make the front page. So I'll cover some of those recently as well. Some of those that I recently covered as well. All right, so what this is, I've shared this in the past, and some of you may have seen something like this or similar on the web or elsewhere. This is just a cyclical, phase, stages of a bear market, and really bull market as well to cover. So what you can see is it has, how a bull market starts. And if you recall back in 2009, haven't had my coffee yet, guys. Back in 2009 when the market bottomed, it took off, and of course it was a pretty impulsive move, and there were some give or takes there. But the way I equate this, if you look at a chart, go back about 10 years, cover the entire bull market that we just went through, or possibly still in, we'll see. This to me looks like that period back in 2015. We had almost 2 years of sideways trading, but with two big corrections and quite a lot of sectors and even the small cap stocks dropped 20% or more. So it was really a rolling bear market. A lot consider that. Like I say, I don't get tied up too much in the semantics of, a bear market being a drop of 20% or more off the high. Like I said, we just dropped 23% on the Nasdaq 100, 19.97 from the highs to low on S&P 500. Bear market is really more how stocks are acting. So we had a little bear market, or at least a consolidation, and maybe call it a bear trap as well, because after that period in 2015, the market really, this seemed to be the stage that we had, and you can see from the Trump pump here around 2016, that's when things really exploded. We had that 2 years of record low volatility, never before seen in the financial markets. And that took us up to those January highs. Or I'm sorry, we had a little blip there earlier in the year. But let's just for the all intents and purposes, again, this is just a rough sketch of how bull and bear markets usually play out. Let's just say that was the high that we had this fall. And so what we had here is this return to normal phase. I think that's where we're at right now. And there may be more to that. Again, these things aren't always to scale, but this is how, at this point in time, I'm viewing this counter trend bounce. And I said this before recently. The market isn't going to resume or take its next major leg down until the masses must believe that this was just the drop back in the fall of last year was nothing but just a great buying up. And once everybody believes that, and believes that this, even though we're already in the was it second longest, nearly the second longest bull market in history. It is the second longest, almost the longest in history, longest economic expansion in history, and all that good stuff. Once the masses believe that the Fed finally has this thing figured out, for the first time in history, the Fed has figured out a way to prevent recessions and bear markets indefinitely. That's when the market will have topped. Obviously, I'm being facetious. The business cycle is just a natural part of the economy. It's always been that way. You have economic expansions and contractions. You have bull markets and bear markets. And this just happened to be one of the longest in history, fueled by that easy money policy of the Fed. So again, where we're at right now, not to scale, but it could come. It could come any day now. Or it may continue on. And like I said, anything's possible. I stay open. I try to keep a flexible mind. If we happen to, I think really in the next few weeks here, the next couple, depends how we trade. If we trade sideways and flat, that won't tell me much, and that might be healthy and give us some fuel for another major leg up. But again, depending on the next month or so, might have a good idea whether we are going to have a chance to challenge and even take out the new highs or not. But as of now, I just want to make clear that I'm not expecting that. And the one thing again I want to point out is, remember, a top may come out of nowhere just when it looks like the market will never stop going up. If you don't know what I'm talking about, think back to what you were thinking on December 20th, 21st, 22nd, 23rd, leading up to that low on December 24th. It was the whole henny penny, the sky is falling thing. The market would drop forever. I'm sure a lot of people thought that way. And then all of a sudden, we closed Christmas Day, and December 26th changed things, and the market never has not looked back since then. We've had one little correction on the way up. So I just want to say that. And it works, what I'm getting at, it works the same in reverse here. Just when things look like the market is bulletproof and will not stop going up, and you got to jump back in or miss out on the road to new highs and beyond, that's when things will probably change. Okay, as far as the broad markets go, really nothing new to add. If you've caught any of my recent analysis, you can see, we had that again very impulsive move off the bottom there, followed by wrong drawing tool here, impulsive move off the bottom. We've had one correction so far, and again, corrections are healthy. I said at the time that clears out the near-term overbought conditions and gives you the fuel for that next leg up, so you're not too extended. So what's happened here, we had another strong leg up, too extended. We haven't really corrected. We're correcting a little bit in time, and I always say this: there are two ways for stock or the market to correct and work off overbought conditions. They can do so in either time and or price or any combination thereof. So far, this has been a little bit of a sideways consolidation in time, and if we don't pull back, I think we'd need a little bit more. I would be pretty surprised. Nothing really shocks me anymore, but pretty surprised to see this market just continue on up, let's say to that 200-day, to make a run at the 200-day without any more consolidation or another pullback first. So, and I'll tell you, it's starting to get to the point now. I've said this before. I think the easy money off the lows have been made. Last week, for the first time, I took a little bit. I told you guys, scaling into 401k long-term IRA stuff. For long-term stuff that don't, try to get cute and game the counter trend pullbacks as I will in my trading account. Not only that, you can't do that in a 401k. You have in and out restrictions. You can only trade all your trades, no matter when you place an order, go end of day, that kind of stuff. IRAs, you can get a little more flexible if it's a brokerage IRA, because of course you have the ability to short with ETFs and things like that. However, the point I'm trying to make is I think at this point in time that the risk reward, not just for this initial leg up, I've been talking about that on trading accounts and active accounts, but even for if you take that mindset, again, it's really, nobody can say definitively, but I can make a case technically and fundamentally that this was likely the top back here. Let me show you that this was likely the top, and this is a counter trend rally in a bear market with more downside to come. And if that's the case, and like I said, just like on December 24th, we turned on a dime, the same thing can happen to the upside. It can take one little catalyst to set it off. The markets are fickle. For example, now we're at the longest government shutdown in history, and the markets don't even care. They don't seem to be concerned. And all of a sudden, just like Brexit, everything else that they told you at the top, things that I mentioned when we started going down, all those issues, the ballooning federal deficit, the interest rate hikes, aggressive Fed, Brexit, you name it, trade wars thrown in all there. That was old news for a very, very long time. And then all of a sudden, at least what the media tells us, the market started to care. And, I made it very, very clear leading up to that top. And then the day we broke down that it was technically based, and then selling begets more selling, and it's a domino effect. So it was technicals, but of course, then the fundamentals do come into play, if that makes sense. So I'm not trying to say that, the markets move solely on technicals. Fundamentals are in there. It's just funny how the market will, when it wants to go up, when the trend is strong, it will shrug off bad news, and then when it wants to accept that bad news for what it is, it will. So that's what I'm looking at here. So with this point in time, I have to say this. I still favor more upside. I favor a corrective wave here soon, a pullback, and then more upside. So what I'm going to do is, just like I scaled in on the way down, I'm going to scale out on the way up here, is what I plan to do in long-term funds. And, if I find myself sitting in cash at this point in time and the market goes here, no big deal. I'm not losing money. I'll just have left out on, left some profits on the table. And I probably won't, take the last, portion of those long equity funds out until we have some pretty compelling sell signals or pretty compelling technicals. In other words, at the time where I may put on active short trades, quite a few on the site, official trade ideas, that's at the point where I'll probably take my last dollar out of long positions in my long-term accounts, that is. Okay, enough on that. So charts are the charts. There's the 50-day EMA so far. You can see QQQ never actually touched it, came very close. Maybe it's the SMA, it's bouncing off. I'd have to add that to my chart. Doesn't matter. Close enough again. And IWM has already hit it. There's your 200 up there. But we also have price resistance. If you remember, this was, a pretty important level here, right here, here, and here, where the Qs were holding on. And then once that level broke with conviction, we kicked back, had a back test, and then a waterfall sell-off. So as I often say, support once broken becomes resistance, and that's what's going on here. So it doesn't mean that we have to pull back. Like I said, we have been consolidating now. It's been 3 days, 3 candles last week, and we'll see today we're going to open down. We're poised to gap down, not by a huge amount, but again, so there's another failure at that level there. 60-minute chart of QQQ, I still favor, as I do with the futures, pull back to at least this uptrend line here, and at least a reaction. I may have overestimated that reaction there, but also this 155.82. So that remains my target. Let me just go to another monitor. In pre-market so far, the Qs have fallen to 158.70. So we've had a pretty decent recovery off the lows today in the futures, in QQQ and pre-market, but I still think there's more downside. I don't think the overnight correction that we've had so far is it. So I favor more downside at the open today. In fact, it's probably objective to short the gap down, or if they try to buy that back up, you want to look for maybe a backfill. But I doubt it. Looking at where we're at now, I'd put pretty low odds on a backfill of today's gap in QQQ. It hasn't happened yet as I'm doing the video. Remember, we're looking at Friday's closing action here. I'll get to the futures in a second. Let's roll over to SPY real quick. Look at this. SPY is just, a very well-defined resistance level that SPY has stopped cold on. You can see for days we've been trading there. It's around 259.18 or so. And I expect, again, at least a move to the uptrend line, probably a reaction. In fact, I think SPY pretty much hit it in pre-market. Let's see, SPY hit a low of about 256.10 in pre-market. So if I hold my cursor, the crosshairs here where we would open down, no, more downside there. We didn't even hit it yet. It would be about 254.50 to even touch that trend line, and I still favor a move down here to about 251.20. So a little more downside, I think, today and into this week possibly if we don't have a little flush out pullback move today. More downside in SPY. All right, so let's look at the futures. So NQ, very close. Here's that yellow uptrend line. I've been calling for a tag for a while, and again, it's been more of a slow roll. It's not like we've been rocketing up, but we haven't gone down, just sort of sideways trading now for the last week or so. And we came close today, but I still favor a move down. And now I think that trend line will get hit. Probably get a reaction there first, a little bounce or consolidation, but still favor a move down here as I have been for the last week or two to about 64.1050 or so. That's NQ, the S&P 500 E-minis. And then let's try, I'll get to CL in a second. Let me find ES. Here we go. ES actually has hit that trend line in pre-market. And again, these are the S&P 500 E-mini futures. There's the uptrend line. So we're pretty much flirting with that. But whether we get a reaction off that or not, maybe, they buy it into at the open, buy up the gap. You could, of course, try shorting here about 25.94 or so. But a break of this trend line, a solid break of this trend line. But remember this, guys, it's a little tricky right now, and I want to say that, and this is why I'm still keeping things light. My convictions aren't very high. So let's say SPY does break this, or ES, I'm sorry. ES breaks this trend line. Jump back to NQ. Like I say, when you have a trade, you want to see both of these go. So your sell signal won't come on just ES breaking that. Even if you're an ES trader, you want to see NQ also break that trend line there, and that might give you a quick pullback trade on the short side. And one more thing, I'll note that trend indicators, you can get some whipsaw signals, that's to be noted, but so far you have the PPO signal line, the 9 EMA, which I use as a trend indicator, moving below the zero line on NQ and ES as well. That typically denotes, and again, short-term trends. It's only a 60-minute chart, intraday chart, but you can see when that white line, which is the last of the two to cross, when it's below zero, you can just look at prices above. Typically the trend, that near-term trend is bearish. So that is right now. We have a cross below zero after a successful, maybe a slight whipsaw. Again, you can't hold it. It doesn't. Sometimes you'll whip through a little bit, but for the most part, this line acts as support or resistance when tested from above or below. At this point in time, at least over last night's session, we're pretty clearly below that level now. I'm going to wrap it up here. I'm looking at the clock. It's 15 and a half, almost 16 minutes. So what I'll do, I've mentioned this being for members only. I'll do a separate video or put up some posts on the trade ideas that we've been in lately, the timber stocks, lumber, timber ETFs, home builders, and some of the other things that we have right now as active trades or unofficial trades on the site. I'll follow up on another video there. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.